सूचना संबंधी सभी दस्तावेजों को सावधानी से देखें।
All right, so let's begin this deep dive conversation. I have with me Kailash Kulkarni of HSBC Mutual Fund, and today we'll be talking about everything. The recent RBI rate cut. We'll be talking about a sum up or a recap of this particular calendar year and what's the outlook for 2026, because we definitely need an advice to navigate through our portfolio and investment strategies. Hi, good evening, Kailash, and welcome to this very special edition of the Money Show today. And your first comment on the RBI rate cut. I know it was expected, but the kind of tone and the stance, does that also stand expected according to you?
Well, thank you for having me on the show, and welcome to the listeners also. GDP had touched 8%. There was a lot of, some people had decided that now maybe possibly there'll not be a rate cut, but we continued to hold the stance that there will be a rate cut. I think there are a lot of positives in this policy. The governor has done a fantastic job in addressing a lot of queries in the Q&A post the policy. But the most important thing is 25 basis rate cut and a stance which is neutral. What the governor has said is that they are looking at a benign inflation. They're not looking at inflation going up. In fact, going into Q1 and Q2 of FY27, he's talked about a 4%, which is lower than the 4.5%, 4.6% as what they had predicted earlier, clearly signaling that inflation will be soft. Growth is continuing around 7%, 6.8 and 6.7 is what is predicted for the first 2 quarters of FY27. So I think all in all, a very positive policy. Second, he has addressed liquidity issues by announcing OMOs. So 1 lakh crore of OMOs in December, another 50,000 crore of FX swap, 3-year FX swaps that he talks about, liquidity infusion of 1.5 lakh crores just in the month of December. He's also addressed the question on the rupee, which has fallen. And he really said monetary policy and rupee need not be interlinked completely. So I think he has shown a way wherein, while he's kept the stance neutral, he has said that it's going to be data dependent. So are there possible rate cuts in future? The answer could be, but it'll depend a lot on the data.
Also, let's also talk about investment strategies as far as debt is concerned now. Also, one question I want to understand from you is, are you looking at this rate cut as the last in the entire cycle? What's your take on that? And also, what should be the strategy as far as fixed income is concerned in mutual funds?
So we are not looking at this as the last of the rate cuts for a long, long time. Like the governor has said, it will be data dependent. In fact, he used one very interesting word. He said, why can't we have aspirations to grow at 8% for the full year? And if you want to really grow at 8%, the government stimulus is always welcome. So if the data proves to be the way the governor is expecting it to go, there can be possibility of rate cuts in the future, but we'll have to wait and watch depending on the data. As far as fixed income is concerned, I think it's very important that individual investors start considering fixed income to be a part of their asset allocation. What we typically see at the super HNI or the HNI end, there are investors who invest in fixed income as a part of their asset allocation. However, when it comes to medium net worth investors or retail investors, they prefer equity or hybrid or multi-asset. But really speaking, on the fixed income component is more in the traditional products like bank FDs or fixed return instruments, which some of the corporates are issuing, or some government schemes which are there. So I think with the interest rate scenario likely to remain soft for some time and possibility of rate cuts in future, I think it's a good time for investors to also consider for the shorter end, which is typically 1 to 3 year kind of investment horizon, to look at fixed income as part of their portfolio.
Let's also talk about this entire year, because we are almost at the end of this calendar year now. What worked and what did not, according to you, for the markets?
I think let me start although you should always start with positives as to what worked, but
Yeah.
actually we had a very volatile year. First is we have to accept the fact that we had a very volatile year, but the volatility was mainly on account of global factors more than local factors. So if we look at it, we started off with the US imposing much significant tariffs on India as compared to rest of the countries which were there. And that continues. Today, we are one of the highest tariff countries in the world. Are we working towards a solution? Yes, the government is working towards a solution on that. So that didn't work. The rupee falling did not work. FPI is pulling out because they saw value in other countries, did not work. But despite that, look at our inherent strength of India, the GDP has grown very well. In fact, the GST cuts have really benefited all of us. But global factors have played that the market didn't give enough returns as compared to how well our GDP is doing. I think it will reverse out shortly, and we are quite confident that hopefully we'll come to some kind of understanding with the US and some of the tariffs will be rolled back, or at least part of it will get rolled back. More important, this also gave us an opportunity wherein the government has stitched together a lot of bilateral trade negotiations across multiple countries in the world, so partially offsetting the hit which was done by the US tariffs. The rupee depreciation also has helped to some extent exporters because it benefits the exporters a lot. I think all in all, we are looking at quite favorably. And because the corporate India is doing very well, we believe the market should soon recover and domestic flows continue to be very, very strong. So how are we looking at 2026 as compared to 25? I think we are in a much more positive frame of mind when it comes to what's going to happen in 2026.
So what's going to happen in 2026? What sectors are going to play out? What is the outlook like? What is the fund voice over here?
So when it comes to next year, which are the sectors which we expect? I think there are four pillars. And within those four pillars, there are many, many smaller sectors or bigger sectors which will continue to do well. But the first pillar is manufacturing. I think in manufacturing, very clearly, we are seeing government support through PLI incentives. And unlike in the past, where maybe 2 or 3 states captured most of the manufacturing new capacities, today we have nearly 8 states across the country which is fighting or vying or competing against each other to get manufacturing capacity set up. So we are seeing this happen across north, south, east, and west, which is very positive for the country. Infrastructure is a second big space, obviously led by the government, including state governments, who are putting in a lot of effort to improve or create new infrastructure, whether it is ports, airports, roads, railways. In fact, railways, I should point out, the dedicated freight corridor work is happening at a very fast pace. Bridges, flyovers, power generation, especially solar power. We are talking about metro railway. So I think a whole lot of work is happening there, and that's going to be a big driver. Third is, of course, consumption. With the background of GST rate cuts, we have seen consumption take a big jump. We've been reading data about the number of cars being sold, the number of white goods being sold, the number of phones being sold. But I think consumption has got a very big boost. I think with the rate cuts which have been announced today, we should see further acceleration with EMIs coming down. I think there's a big positive. And the fourth pillar, I think, is the financialization stroke digitization, which is actually the underlying force driving a lot of transactions, speed of processing, etc. So I think all these four pillars is something that we believe not only will go through 26, but also for the next few years, we should see these sectors work.
Last question to you, and then we'll wrap up this discussion. I just wanted to understand. So now the coming year, how would you like to advise our viewers to, alter their return expectations? What should be the return expectation band according to you?
So I have a simple formula on this, Kavita. I believe that if you're getting an X% return on your fixed income, if you're getting 50% more than that, because you're investing in equity, equity is more risky, it is more volatile, you should be a happy person. If you get more than 50% of your fixed income return, then that you should treat like a bonus. So if hypothetically, if you assume that you're getting 7.5 in a fixed income instrument, you're talking of 10 to 12% in equity. That should be, you should be a satisfied investor. If you get anything more than 12, which what most mutual funds have given over the last 5-10 years, I think you should actually treat that as a great bonus that you have received. And the more your expectations are, if you just go by, if you leave aside 2025 and you take 21 to 24, and if you go by that trend, you'll actually have very high expectations, which is likely to disappoint you. So my suggestion to all investors is keep your expectations in control. And if you believe this country is going to be the next big driver of growth, then you will not be disappointed at all.
All right, so that's the take and that's the word. Thank you so much, Kailash, for being on the show and helping our viewers understand the market movement ahead. Thank you.
Thank you so much.
And with that, it's time for a short break on the Money Show as well. See you right back.